Preparing for a financial analyst at Metro interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What interests you about becoming a financial analyst at Metro? I would start by explaining that Metro's financial analyst role connects commercial performance with disciplined planning. In a wholesale business, I would analyze sales by customer group, gross margin, operating costs, and cash conversion. I would then translate findings into forecasts, variance explanations, and recommendations for management. Strong performance means not just reporting numbers, but helping teams make better decisions using reliable, timely analysis and clear communication. While answering, focus on Metro's wholesale business model, the link between analysis and commercial decisions, your interest in retail or distribution, and examples showing accuracy, curiosity, communication, and practical problem-solving. Question 2. What do you know about Metro's business model? Metro serves professional customers such as hospitality businesses, independent retailers, and other organizations through wholesale stores and delivery channels. Its economics depend on sales volume, product mix, gross margin, inventory availability, and efficient operations. I would also consider country and channel differences when interpreting results. That combination makes the analyst role commercially relevant. The numbers should explain how Metro can grow customer value while protecting margins and cash generation. Make sure to cover Metro's focus on wholesale customers, stores and delivery channels, product assortment, professional customer relationships, geographic operations, and how scale, margin, working capital, and service quality affect financial performance. Question 3. How would you build a financial forecast for a Metro business unit? I would build the forecast from operational drivers rather than applying a single growth percentage. I would estimate customer numbers, purchasing frequency, average basket size, volume, price, product mix, and channel-specific margins. Then I would model operating costs, working capital, and relevant seasonality, validating assumptions with commercial stakeholders. Finally, I would create base, upside, and downside cases, reconcile the model to financial statements, and document every material assumption. In your answer, talk about historical trends, operational drivers, management assumptions, seasonality, customer and channel segmentation, scenario analysis, reconciliation to the income statement, and regular forecast versus actual updates. Question 4. How would you explain a significant variance between actual and budgeted results? I would first confirm that the variance is real and not caused by a data or timing issue. Then I would bridge the difference into price, volume, mix, foreign exchange, cost, and one-off components. For example, lower margin might reflect higher sales but an unfavorable product mix. I would validate the explanation with operations, assess whether it is temporary or structural, and update the forecast with a clear management recommendation. Be sure to mention separating price, volume, mix, timing, foreign exchange, and one-off effects, quantifying each driver, confirming root causes with stakeholders, and recommending corrective actions rather than simply describing the variance. Question 5. Which KPIs would you monitor for Metro? I would monitor KPIs across growth, profitability, operations, and cash. These would include total and like-for-like sales, customer count, average basket, volume, gross margin, product mix, EBITDA, expense ratios, inventory turnover, stock availability, receivables days, and cash conversion. I would always connect KPIs rather than viewing them separately. For example, stronger sales are less valuable if discounting reduces margin or inventory growth absorbs the cash benefit. Focus on sales growth, like-for-like performance, gross margin, EBITDA, customer activity, average basket, inventory turnover, availability, delivery economics, operating expenses, working capital, and cash conversion. Question 6. Explain the difference between gross margin and EBITDA margin. Gross margin measures revenue less the direct cost of goods sold, divided by revenue. It shows the profitability of the product offering before operating expenses. EBITDA margin goes further by subtracting operating costs such as personnel, rent, and other overheads, while excluding interest, taxes, depreciation, and amortization. In practice, gross margin helps assess pricing and mix, whereas EBITDA margin shows whether the broader operating model is generating sustainable earnings. Make sure to define both margins, explain their income statement positions, discuss the costs included in each, and show why management uses them differently when evaluating pricing, assortment, and operating efficiency. Question 7. How would you analyze a decline in gross margin at Metro? I would begin with a margin bridge by country, channel, category, and customer segment. I would test whether the decline came from lower prices, heavier promotions, supplier inflation, unfavorable mix, foreign exchange, shrinkage, or an accounting classification issue. I would compare realized margins with commercial plans in prior periods, then discuss actions such as targeted repricing, supplier negotiations, assortment changes, or promotion discipline. I would distinguish temporary pressure from a structural trend. In your answer, cover pricing, promotions, supplier costs, product mix, shrinkage, foreign exchange, customer segment, procurement effects, and accounting issues. Then explain how you would isolate drivers and propose actions. Question 8. How do the three financial statements connect? The income statement shows performance, the balance sheet shows financial position, and the cash flow statement explains movement in cash. Net income increases retained earnings, while depreciation reduces profit but is added back in operating cash flow. Changes in receivables, inventory, and payables affect cash even without changing current period profit. Capital expenditure affects fixed assets and investing cash flow, while debt or equity financing changes both the balance sheet and financing cash flow. Be sure to explain how the income statement flows into retained earnings, how balance sheet changes drive cash flow, and how depreciation, working capital, investments, financing, and cash balances connect the statements. Question 9. How would you assess working capital in a wholesale business? I would analyze inventory days, receivable days, payable days, and the resulting cash conversion cycle. Inventory deserves particular attention because Metro must balance product availability against markdowns, obsolescence, and cash tied up in slow-moving items. I would segment the analysis by category, location, and channel, then investigate demand forecasts and supplier terms. Any recommendation should protect service levels. Reducing inventory indiscriminately can damage sales and customer relationships. Focus on inventory, trade receivables, trade payables, cash conversion cycle, days metrics, seasonality, availability trade-offs, slow-moving stock, payment terms, and actions that improve cash without damaging customer service. Question 10. Describe how you would build a monthly management report. I would design the report around the decisions management needs to make. It would include a concise executive summary, sales and margin trends, cost performance, cash and working capital indicators, KPI movements, and a forecast outlook. I would validate source data and definitions before publishing, highlight material variances, and use bridges or charts where they improve clarity. Each section should explain the driver, business impact, owner, and proposed next step. Mention data validation, consistent definitions, actual versus budget and prior year analysis, KPI dashboards, materiality, concise commentary, visualization, stakeholder review, and an action-oriented summary for decision makers. Question 11. What steps would you take to ensure data accuracy in Excel or reporting system? I use a controlled process rather than relying on visual inspection. I reconcile source totals to the general ledger or approved system reports, check record counts, test formulas, review unusual movements, and compare outputs with prior periods. I separate inputs, calculations, and outputs, label assumptions, and maintain version control. Before distribution, I perform an independent reasonableness review and retain an audit trail so another analyst can reproduce the result. Talk about source reconciliation, control totals, formula checks, independent review, version control, locked assumptions, exception testing, audit trails, and clearly defined data ownership and reporting cutoffs. Question 12. Which Excel functions and tools are most useful for financial analysis? I regularly use SUMIFS, XLOOKUP, index match, IFERROR, date functions, pivot tables, and dynamic charts. For larger data sets, Power Query can standardize and refresh information efficiently. I also use scenario tables and sensitivity analysis to test assumptions. Good Excel work is not just knowing functions. It means structuring the model clearly, separating inputs from formulas, avoiding hardcoding, checking outputs, and making the file easy for another person to review. Mention SUMIFS, XLOOKUP or index match, IFERROR, date functions, pivot tables, charts, conditional formatting, scenario tools, Power Query, and model structure, while emphasizing logic and error control over memorized functions. Question 13. How would you evaluate a capital investment proposal for Metro? I would evaluate the investment using incremental after-tax cash flows, not accounting profit alone. The model would include initial CapEx, implementation costs, revenue or productivity benefits, operating expenses, working capital, taxes, and terminal assumptions where appropriate. I would calculate NPV and IRR, review payback, and test sensitivities around sales, margins, costs, and timing. I would also assess strategic and operational risks, then define KPIs for post-investment review. In your answer, cover incremental cash flows, CapEx, operating benefits, working capital, taxes, depreciation, NPV, IRR, payback, sensitivity analysis, strategic benefits, risks, and post-investment performance tracking. Question 14. What is the difference between an accrual and a cash expense? An accrual records an expense when the service or goods are received, even if payment happens later. A cash expense is recognized when money leaves the business. For example, if utilities consumed in December are paid in January, December should include an accrual and January should reflect the cash settlement. This distinction ensures period results are meaningful, while the cash flow statement separately captures the timing of payment. Be sure to explain recognition timing, matching expenses to the period benefited, unpaid liabilities, prepaid costs, cash flow effects, month-end adjustments, and why accrual accounting improves management reporting. Question 15. How would you approach budgeting when business conditions are uncertain? I would avoid presenting one forecast as a fact. I would build a driver-based base case and add downside and upside scenarios around demand, pricing, supplier costs, foreign exchange, labor, and inventory. I would identify leading indicators that signal which case is emerging and define management actions for each outcome. A rolling forecast can then update the outlook as evidence changes, while clearly distinguishing committed costs from controllable assumptions. Focus on driver-based planning, multiple scenarios, probability-weighted assumptions where appropriate, sensitivity analysis, rolling forecasts, leading indicators, contingency actions, and transparent communication of uncertainty. Question 16. Tell me about a time you found an error in a financial analysis. In a monthly analysis, I noticed that one region's expense ratio had moved sharply despite stable activity. I traced the issue to a duplicated upload caused by a changed file format. I reconciled the data to the ledger, corrected the report, informed the manager before distribution, and added a duplicate record check to the process. The experience reinforced that unusual movements should be investigated, even when the overall report initially appears reasonable. Use a concise star. Question 17. How would you communicate disappointing financial results to a non-finance stakeholder? I would lead with the business message, not a technical accounting explanation. For example, I might say that profit is below plan because volume weakened in one customer segment and logistics costs increased. I would show a simple bridge, separate controllable from external factors, and explain the forecast implication. I would then discuss practical actions with the stakeholder and confirm ownership. Clear communication should create alignment, not merely document poor performance. Mention starting with the business implication, using plain language, separating facts from judgment, showing key drivers visually, acknowledging context, agreeing actions, and avoiding excessive accounting terminology or defensiveness. Question 18. What would you do if a senior manager challenged your analysis? I would treat the challenge as an opportunity to test the analysis. First, I would clarify whether the disagreement concerns data, assumptions, definitions, or interpretation. I would revisit the source information, reproduce the calculation, and compare it with the manager's operational knowledge. If I found an error, I would correct it promptly. If the analysis remained sound, I would explain the evidence respectfully and show any sensitivity around the conclusion. In your answer, cover listening carefully, clarifying the disagreement, checking assumptions and source data, remaining objective, revising conclusions when evidence changes, and presenting a documented, respectful resolution. Question 19. How would you use Power BI or another visualization tool in financial analysis? I would use a dashboard to make recurring analysis faster and more actionable. After cleaning and modeling the data, I would define consistent measures for sales, margin, costs, and working capital, then provide trend views with drill down by country, channel, category, or customer group. I would reconcile the dashboard to approved financial reports and control refreshes. The design should highlight exceptions and drivers, allowing managers to investigate without waiting for manual reports. Discuss clean data modeling, consistent KPI definitions, drill down capability, automated refreshes, user-focused design, access controls, reconciliation to finance systems, and using dashboards to support decisions rather than decorate reports. Question 20. Why should we hire you for this financial analyst role at Metro? You should hire me because I combine strong analytical discipline with a practical business mindset. I can build reliable models, investigate variances, and work confidently with Excel, reporting systems, and financial statements. Just as importantly, I communicate findings clearly and turn analysis into actions for non-finance colleagues. Metro's scale and wholesale complexity would let me contribute through accurate reporting, better forecasting, and thoughtful insight into growth, margin, costs, and cash. Be sure to connect your technical skills, commercial understanding, attention to detail, ownership, communication, adaptability, and motivation to Metro's need for accurate analysis and practical recommendations in a complex wholesale environment. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.